Okay, ready for the debate session. Next up is the provocative debate session where certain policy aspects of U.S. international tax reform will be debated. Some of you will recall the theme from last year's NYU KPMG tax lecture. It was U.S. tax reform, a perfect storm. As some of you will perceive from the debate discussions to come, it seems that we are still operating under a cloud or a thick fog as an aftermath of that perfect storm from last year. As noted, this session is going to be somewhat audience interactive. Some of you have handheld polling devices. They will be passed around throughout the auditorium in the next few minutes, and you can react to certain polling questions during the course of the debate. The debate is going to be moderated by Willard Taylor, and the debate team includes Professor Daniel Shaviro, Kimberly Blanchard, Dana Trier, and Tom Zollo. Willard Taylor was a partner with Sullivan and Cromwell for 35 years and remains of counsel to the firm. Willard is a former chair of the tax section of the New York State Bar Association and as an adjunct professor at NYU Law School. Professor Daniel Shaviro is the Wayne Perry Professor of Taxation at NYU Law School and formerly served with the Joint Congressional Committee on Taxation. Professor Shaviro teaches tax policy-related topics at NYU and is a prolific author on topics involving tax policy, budget policy, and entitlements issues. Among many of his writings, Professor Shaviro authored a book several years ago entitled Fixing U.S. International Taxation, which was published in 2014. Interestingly, or surprisingly, his book did not even mention GILTI, the BEAT, or FDII. Kimberly Blanchard is a tax partner with Weil, Gotshal, and Manges. Kim speaks frequently and writes extensively on many aspects of U.S. international tax. Kim is a former chair of the tax section of the New York State Bar Association and a former president of the International Tax Institute. Kim earned her JD degree here at NYU Law School. Dana Trier is of counsel with Davis Polk & Wardwell. Dana recently served as Deputy Assistant Secretary for Tax Policy in the U.S. Treasury Department, where he oversaw the Office of Tax Legislative Counsel. Tom Zollo is an international tax principal with KPMG's Washington National Tax Office based in Chicago. Tom is a frequent speaker and writer on international tax matters. The debate is going to address 4 different debate propositions in all of 60 minutes. Debate team, please assume your positions. Place you like. Well, I tried to give you a few more.
Okay, thank you, Larry. So usually we have trouble coming up with debate questions, but this year is a lot easier, I think. And the first proposition for debate is GILTI. But this is the way you respond, by the way. At the end of each debate question, we're going to poll the audience. So forget that slide for the moment. Global Intangible Low Taxed Income, or GILTI, and as you know, and I'm not going to go over it in much detail, GILTI is included in gross income, much like a Subpart F inclusion, and basically it's the excess of the corporation's net income, exclusive of certain items like Subpart F income. Over 10% of its investment in qualified business assets, and there is also a 50% deduction for GILTI that's granted by Section 250. And so GILTI aims to tax low-taxed income of a controlled foreign corporation that would otherwise not be subject to current U.S. taxation. It's not Subpart F income, and it's not necessarily remitted. Is this a worthwhile goal? Does GILTI achieve its goal, or is there a better way to address the issue? Dan, do you want to?
Sure. Well, as written, I'm probably a little bit on the fence about this one, but I think I should probably say yes, because there'll be people here to say no. I do agree it's a worthwhile goal. Will it achieve the goal? That's surely overstating it. It's being a distorted calculation of income derived from intangibles. I see no reason why it has to be just about income from intangibles. There are better ways to do this. Well, anyone who has an idea, please step forward. If it's not too self-indulgent to say this, I'll note that GILTI, even though I inexplicably failed to mention it in my 2014 book, except for the pocket part, of course, it does, I think, it is consistent with some of the things I say in the book about how international tax policy should be structured. And if you look at countries around the world and at their CFC rules, they almost invariably are interested in foreign source income that ends up being in tax havens or paying very little tax. And even though there's no particular reason for a home country to want their multinationals to pay more foreign tax rather than less, there are reasons for this, because when you see income in tax havens, you rightly suspect that some of it might have been kind of drained from the domestic tax base through profit shifting. One of the problems with setting policy in this area is that it's awfully hard to know. I call it a Goldilocks problem, too hot, too cold, or just right. It's sort of hard to know just what the right level of attacking this problem is, because in principle, if you're eliminating domestic taxes, then that might be something you don't like, although in truth, you might want to let the multinationals lower it a little bit so that they will be more willing to invest there. But if you're saving foreign taxes, that's sort of fine. So it's kind of hard to know really what the right thing to do here. This is sort of an imaginative, creative, and new way of doing it that I haven't seen in prior countries' Subpart F rules. Is it too harsh or too light? Hard to say. I do think it's smart in the design, that, and this is something I'd advocate, that they don't give you dollar for dollar tax saving on foreign taxes paid with respect to GILTI. And I do think the 10% rate of return is a bad rule. Essentially, whenever the rate of return that you allow someone to deduct from the measure is higher than your actual expected rate of return, it kind of creates an incentive to put tangible assets abroad, which is not the purpose of the act. I don't know for sure how serious or unserious, how grave or less grave this problem is, but it seems to me like kind of a odd way to go about it. You'd really want to try to hit at the expected rate of return, maybe even have it relate to prevailing market interest rates. So it's very far from perfect. But I have some sympathy for what they were trying to do, especially under the time pressures and everything else.
Kim, do you want to speak?
Yeah, I think actually Professor Hay in the audience suggested the way to do this. I took it from your comments. Many years ago, I tried to write a paper. It didn't make its way into a book, unlike Dan's, where I said, why don't we just tax controlled foreign corporations on their income and get rid of all this E&P nonsense and all this sort of overlay of subchapter C in the international area. And I started to write the paper, and it just got too hard, so I never finished it. And one of the reasons it got hard was that I kept stumbling across how you deal with things like foreign tax credits. So they solved that problem in enacting GILTI. They just put it on top of the system we already had and instead of trying to start over. But I think GILTI would be fine if it were a replacement of what we had and then thought through carefully how it would work. The big problem, I think, with GILTI is that we actually don't know what Congress intended. As many of you may know, there's a sentence or paragraph in the legislative history where Congress tells us that they really didn't mean the GILTI tax to apply as long as the local tax rate was at least 13 1/8%. But that's not what they wrote. And it's very unclear how we deal with the foreign tax credits, how we deal with expense allocation, very unclear what they meant to do about that. So Willard, just to wrong foot my debate opponents, I have to do something stupid and pointless in every debate. So what I'm going to do here is
Usually you win, though.
I have a little aphorism or saying for each one of these. And the one for guilty is, do as I say and not as I do. And what I mean by that, when you think about guilty, think about whether we're supposed to be interpreting it the way Congress apparently wanted us to interpret it, or whether we should interpret it in terms of what Congress actually wrote.
Thank you. Tom, want to
Yeah.
weigh in?
Sure. Well, I'm not sure how I will answer this. I will say it may not be worthwhile, but it was certainly necessary because, as Tom Berthold just pointed out, there were two problems with the U.S. international tax system. One was our rate was too high. The second is we didn't have an exemption system. And moving to an exemption system without broadening our anti-deferral rules could have been a disaster because you'd be relying on traditional Subpart F and transfer pricing enforcement to protect the U.S. tax base. It strikes me that the 10.5% rate, or the roughly 13% you need to get to have a full foreign tax credit, is about right, because in the post-BEPS world, if tax havens get put out of business, it'd be a hard time not to average to that on substantial foreign operations. And so I think it achieves its goal in a broad sense. Now, it is a little bit of a Monet. It looks fine from a distance, but when you get up close, it's not so great. And, a couple of the problems have already been pointed out. First, the 10% return on Q-buy is completely arbitrary, and it favors foreign investment in tangible assets over service businesses, for example. And second, the foreign tax credit mechanism is just a complete mess. One of the biggest problems is the year-by-year foreign tax credit with no carryover, because if you have a company with domestic losses, eventually those are going to get characterized as guilty when they come out of the domestic loss, and they have to shelter that with just current year foreign tax credits, the foreign taxes that really are associated with that income having been incurred in prior years. So, there are a lot of problems with that and the basket issue under Section 78 that need to be worked out. But, given the current political environment, I don't think you could expect perfection at the time of enactment. And this is, I think, the first strike of the scalpel. You can't expect the statute to be done until we have a few more whacks at the marble.
Dana?
Well, I'm embarrassed to say that I think the other three people have said elements of my view. I believe there has to be something similar to the guilty. I'm generally sympathetic to it. Similar to Tom, I think there has to be a provision like that. I think it's a good start. In my particular case, the issues that I have with it are principally the technical issues that relate to allocation of expenses, the foreign tax credit mechanism, more broadly what Kim referred to, putting this on top of the existing rules. If our political system was such that some of those issues that are in the current statute could be worked out in the manner that other tax legislation has been worked out over time, I would think that something like the guilty is a good start, and it's probably the element other than the participation exemption that I have the most favorable view of in the legislation, in the international legislation.
Okay, so we'll find out what the audience thinks now. Is that right, Larry? All right. So here are the choices. Maybe we should have had a third choice, more reflecting the comments here, but yes, guilty is a worthwhile goal, or aims to achieve a worthwhile goal, and the inclusion of guilty in income will achieve that goal. No, distorted calculation of income derived from intangibles. There are better ways to do this.
Is Barthold voting?
He votes twice, yes, once no.
I would love to see that.
Okay, so it turns out that contrary to the views up here, that 59% think no, distorted calculation of income derived from intangibles, there are better ways to do it. 41% thinks it's a worthwhile goal, and guilty as inclusion will achieve that goal. Okay, so let's see if we can do better next time. Okay, so second question is on FIDI or FIDI, or however you want to pronounce it. And FODI,
FODI or FIDI?
another alternative. There was a Wall Street Journal article, actually, in which they talked about the difficulty of announcing some of the GILTI, FODI, QUABI, et cetera, phrases. Anyway, in order to encourage intangibles to stay, the Act allows, in Section 250, a U.S. corporation to deduct 37.5% of its FDI or FODI, thus bringing the effective rate on FDI or FODI down to 13.125%. And FDI is the percentage of the U.S. corporation's deemed intangible income that equals the percentage of its net income that is foreign derived, excluding Subpart F and certain other items, and its deemed intangible income is the excess of its net income over 10% of the tax basis of investments in depreciable tangible property used in its business. So, Kim, what do you think?
Well, FODI, as I think was mentioned already, is a pretty unstable regime internationally. I think there's a good chance it's going to be challenged. But, the problem with it is it purports to be a benefit given to U.S. taxpayers for intangible income. But just like GILTI, intangible doesn't really have anything to do with intangible. And I know Dan has said that, he thinks that it's too generous in the GILTI case, but, in FODI, it's kind of, the incentive is reversed. 10%. If you want to be in FODI, you want your income to be, quote unquote, from intangibles, and you don't want that return, perhaps too high return on tangible property to be taken into account, which I think creates some pretty bizarre incentives. So even apart from its vulnerability to challenge, I think it's got problems. Having said that, even though Dan hasn't had a chance to state his views on this, my answer to Dan, of course, I have an answer already on a piece of paper, which Peter Blessing already made reference to, so he kind of stole my thunder, but it's what's good for the goose is good for the gander. If you're going to define intangibles this way for purposes of GILTI, maybe Congress felt they had to do it for FODI as well, so we have a very broad incentive.
Tom?
Yeah, I tend to think that the 10% return on QBI is just misguided in both cases and ought to be dispensed with, but it clearly has the perverse result that it encourages investment in tangible assets offshore and discourages the investment onshore. In terms of whether it meets its objective, I think you need to define what its objectives are. One certainly is to stimulate the export of goods and services. It may have some of that effect, although I tend to think that companies will not realign their supply chains based on what they think is going to be a temporary provision. And I think that there is a strong belief out there that FDI is going to have a temporary life, either because it's successfully attacked at the WTO level or just because various countries put in measures that erode the benefit of it. The second, though, is to take the pressure off of the incentive to outbound intellectual property. And I think that FDI and GILTI do work together to reduce, at least temporarily, the arbitrage opportunity, and do have many companies even rethinking their decision to have IP offshore, actually thinking about bringing it back. And the reason for that is that there are many offshore IP structures where the business has never grown up to have a mature and supportable offshore structure with appropriate dumping and so on. And the lower rate on FDI certainly gives them some cover for bringing that IP back.
First of all, I would understand the principal purpose to be Tom's second question, which is second proposition, which is I would look at it as part of a carrot and stick approach, GILTI and FODI combined, that in part addresses the round tripping type of issue where you're moving intangibles abroad and partially importing back into the United States. I don't have as negative a view of the basic idea as many people do. I am not sure whether it will be a nullity. I think Kim called it a nullity in one of her articles. I'm not sure it won't have some effect on the location of intangibles, et cetera. But as was just discussed, I do think the instability of the provision is going to be a central issue in having that incentive effect. So I have a less positive view of this, certainly, than I do of guilty.
Dan?
Well, since I don't like FDII, and it's not because it's a tax break, it's because of something about it, but I'll just start with some points in favor of it. The first is that IP activity may be fairly mobile, both in actuality and in terms of where you report it. That might call for a lower tax rate on it. Second point in favor is that there are already sort of grotesquely exploitable source rules under prior law under which U.S. companies that developed IP in the U.S. could then treat it as foreign source for their foreign sales. And the Act, I believe, tightened up on a little bit of that stuff. And the third is I don't think that they had to identify intangibles directly. It might have made sense, whether it's sauce for the goose and the gander or something else, to kind of back into it the other way, again, leaving aside the point that the 10% rate is probably too high. My problem with FDII is that it's done via an export subsidy. That's the source of the WTO problem, because it's an export subsidy. Patent boxes generally not export subsidies. They might be attacked as, quote, unfair tax competition in OECD, palaver and such, but they're not export subsidies. That's the reason the WTO is probably going to strike it down, and that it's unstable. That's also the reason why it's bad policy, because I don't think export subsidies would find very many economists in favor of them. And it's also the reason why you get into round-tripping problems and things like that. If you have kind of the symmetric treatment of exports and imports that, say, the destination-based cash flow tax would have had, although I had critical things to say about that, you don't really get export subsidies because exports and imports are treated symmetrically. Well, you might get some from sort of tax planning games or avoidance or evasion, but fundamentally the system doesn't create incentives to export something and then bring it back in again. That's what this system does because it's an export subsidy, not a coherent, consistent treatment of exports and imports. It's going to be a tax planning nightmare. There's only so much that can be done about it, and it's just a bad way of doing the understandable objective that they had.
Okay, and now the audience. What do you guys think? The questions are there. Does the way in which the tax base is determined make sense? Does it achieve its intended purpose? What about the 10% return on QBA? Is income above that necessarily related to intangibles? Answer is yes. Encourages U.S. corporations to keep intangibles here. And the base makes sense because it excludes from FDII income not derived from intangibles. No, treating all income as from intangibles other than a 10% return on tangible assets goes too far. What do you think? Well, 75% don't like it. No, treating all income as intangibles other than the 10% return goes far. 25% think it's a good idea. It encourages domestic intangibles to stay domestic, et cetera. So
Things are getting worse.
I want that one.
So we move on to question 3, which predictably is BEAT. And as you all know from this morning and elsewhere, BEAT is intended to prevent perceived base erosion and abuse in inbound transactions, the reduction of the U.S. tax base by foreign investors, and there is imposed in Section 59A a minimum tax of 10%, or the so-called BEAT, on a modified taxable base that disallows base erosion payments made by a U.S. corporation to a related foreign person, including payments for depreciable property but not cost of goods sold. And then there is the threshold of 500 million of gross receipts and a base erosion percentage of more than 3%. So the questions that we will discuss or whether B is too harsh, too mild, or just right. Is it a good approach? Completely misdirected? Where did the 3% or more of deductible expenses come from? Tom, what do you think?
Well, I think, first of all, that answer A is going to win this time by a wide majority. It is,
Who are you predicting is going to win?
it's far too harsh.
Far too harsh.
It's far too harsh because it's overkill. You know, when the BEAT was first proposed, I thought that it was designed primarily to affect base stripping by foreign-based multinationals, and in particular inverted companies. But when you look at its application, it applies extremely broadly and applies in a way that is, in many cases, arbitrary in the way it distinguishes among taxpayers. And you know, one reason for that is that it has a strong preference for companies that make and sell tangible goods over those that provide services. So you could have equivalent companies, you know, one of which operates through buy-sell manufacturers offshore, and because the costs of products go into cost of goods sold, those are not treated as base erosion payments. If, on the other hand, you had toll manufacturing, and the U.S. parent entered into contracts with customers and then subcontracted performance to its foreign affiliates, who then are paid a service fee, virtually everything that's brought in as gross receipts is going to go out as base erosion payments. And so you could have two kind of
UPS or FedEx.
Right. So for service-based companies, and it goes beyond toll manufacturing, it's construction companies, engineering companies, you know, any kind of international service business, it hits them, you know, very hard, and it's not clear why they would be disfavored relative to manufacturing concerns. A second thing is that it hits companies when they're down, because if you have net operating losses or low profitability, your regular tax is going to be low. And even if you have what are relatively minor base erosion payments, you know, just over the 3% threshold, you can get hit with the BEAT. It also disfavors U.S. multinationals that are very successful outside the United States, because as the foreign business grows relative to the U.S., you know, unlike the mechanism under GILTI, where you would think a 13% tax rate ought to shelter you from additional U.S. tax, the foreign tax credit isn't allowed for purposes of the BEAT. So those foreign earnings come back, you know, naked of credit for purposes of the base erosion payment. You know, the final point is that in some ways we're flogging a dead horse. We have interest limitations under 163J, which limit the amount of base stripping you can do via interest. I don't think that, you know, services have ever been a particularly good way to strip income. And when you're talking about royalties, we've already dealt with outbound you know, charges by subsidiaries of U.S. multinationals. So you're really just dealing with royalties that U.S. companies are paying to foreign affiliates, foreign parents. And you know, that has never, you know, in my experience, been a big part of IRS transfer pricing enforcement. So I wonder if that's the last significant piece that needed to be addressed, whether it was best done by casting this very broad net, you know, of the BEAT. You know, call me cynical, but I tend to think that the lowering of the threshold from 4% to 3% and this kind of broad net was done for revenue scoring purposes rather than any good tax policy reason.
Dana?
Well, it's a lot of revenue, and it's going to be difficult to modify it, but I'm, at the end of the day, quite negative on the BEAT. I think, actually, this morning's sessions did a pretty good job of articulating my views. It's partly, as Tom mentioned, once you're in it, the treatment of foreign tax credits, to me, is perverse and harsh. It's also the treatment of services businesses, and at the minimum, quite awkward for services businesses, and is causing quite a bit of change in way of operations. And I also think the netting issue with respect to foreign banks has led to an inappropriate treatment under the BEAT. The problem that I have with respect to the binary nature of the questions is that I actually think in other ways the BEAT is not as good a buttress and base erosion as it could be with the cost of goods sold exception, which seems arbitrary compared to the treatment of services. There's can be a fair amount of embedded interest or royalties. And sort of more broadly, I started to get a little bit of the Kool-Aid on the destination-based approach for inbound matters, and would have preferred a more of an element of that in the base erosion provision. So I definitely believe in a placeholder here. I believe there's room for another significant provision, but I personally don't think the BEAT as constructed is like that. And I think it's less susceptible in its dual nature today to modification and reform than, for example, the GILTI. I can imagine the GILTI evolving in a more rational way with tweaks around the basic system. I don't personally quite see that with the BEAT myself.
Dan?
Well, I have a fair amount of agreement with what's already been said, but I'm going to quote the old joke, how do you like the food here? Oh, it's terrible, and the portions are too small. Well, here it's kind of, yes, it's too harsh, and it applies to too few taxpayers. Is I think the 3% rule makes no sense, and it creates a lot of it's a cliff, and it creates game playing around the margin that's pointless. Also, I think if you're going to have a provision of this kind, the net receipts, the 500 million, strikes me as too high. On the other hand, the regime that would like to apply to people, there certainly are some problems with this one that have been pointed out. It really is kind of about transfer pricing, saying that the transfer price is too high. You could view it as saying that, one way to view it is saying that the correct transfer price is zero, except for the cost of goods sold exception. Obviously, zero is not a plausible transfer price. On the other hand, it is at a lower rate. I guess you could say that it's kind of like having an excise tax on all payments to, all the covered payments to foreign counterparties. And in that sense, I guess you could see an excise tax if the rate was set right as responding to the transfer pricing problem, however imperfectly or crudely. Of course, it's sort of a weird excise tax because once you're on the beat, you face it. When you're not on the beat, it's like a zero excise tax when you're not on the beat. It's a positive excise tax when you are on the beat at the margin, and that doesn't necessarily track to anything else. I am troubled by the ways it can kind of distort supply chains and lead to sort of pointless rearrangement of things, and certainly it can in some cases perhaps be too harsh. On the other hand, it is fairly comprehensive, which makes it less avoidable other than through the cost of goods sold, and there is an issue or a problem there. I'm not quite sure what to do about it instead. Even some of its strongest advocates, like Ty Grinberg, admitted, well, kind of we've thrown up our hands in it and not tried to sort of transfer price more properly, which kind of address what it's aimed at, and so we assume the transfer price zero. So it's a little, I guess there's a lot of revenue, there's a real problem it's addressing. It is hard to know how to do it better. This is a problem that countries around the world have been wrestling with for decades.
Kim?
Yeah, I have a really cynical take on the beat. I'll throw it out there. I don't know if it's right or not.
Unlike the other guys.
Yeah, well, it's awful. I mean, but my take is a little different. Most of the reasons that we've identified for it being awful, the really big problems with the beat relate to what happens when you have a U.S. corporation that is not necessarily foreign parented, but instead just has affiliates, including CFCs. Two of the problems, and I could name 10 if I had time, but two of the problems are that the payments that you're counting toward your modified tax liability by adding them back can include, as was pointed out in a panel earlier, payments to not only a branch with ECI, but also your own CFC, who's taken into account in GILTI or Sub F. which looks a lot like double taxation to me. The other problem, which has been mentioned already up here and in this morning, was that the foreign tax credits get added back, which makes no sense. Now, both of those problems are really problems for U.S. parented groups with CFCs. And so my cynical view of this is that Congress started with something that was really meant to beat foreign parented groups over the head with, including inverted companies. They really wanted to expand our base erosion rules past that for just interest and get at a bunch of other things because they couldn't figure out transfer pricing and didn't trust it. But in order to avoid the charge of being discriminatory or violating our treaties or whatever, and you remember with the old 163J, we said, oh, it's okay because it applies to payments to tax exempts, not just foreign people. I kind of think that's what's going on here, that we're applying it to U.S. parented groups and their CFCs just as a fig leaf to pretend that we're not really going after foreign parented companies. And I think in doing that, we've created a monster. I mean, it was pretty bad anyway, but we've made it a ton worse without, I think, really thinking of it. So my aphorism for the beat is an old standby. Congress, two wrongs don't make a right. Fix it.
Oh, Willard, I'm sorry, can I just say one more thing? One thing I'd like about the beat in principle is the thing that Kim viewed cynically, and that is I argued before the 2017 Act that the U.S. Rules attacking profit shifting place too much emphasis on hitting it by U.S.-headed multinationals compared to foreign multinationals, and you might really want to address it by both. So this is an attempt to redress the balance, despite the problem Kim says, and I think it's probably desirable to redress the balance because we were kind of, via subpart F and the like, leaning, again, it's not to say that we were too harsh on profit shifting, too harsh on U.S.-headed versus foreign-headed. This is an attempt to redress that overall balance a bit, which in principle makes sense, even though, of course, now it applies to U.S. companies. So that's just an example of another good intention underlying it that may or may not have gone wrong.
How is paying amounts to your CFC profit shifting, particularly given the new rules that apply
You're saying
to
because
CFC?
it applies to U.S. companies.
Yeah.
Well, I'm talking about the part that you mentioned, too, which is hitting the foreign companies. Now, that may be, when you said cynical, I thought you were going to say politically, who cares about them in Washington? But it is true that they could kind of had more leeway than U.S. companies. So, no, I'm not disagreeing with you about the part of hitting U.S. companies. I'm saying that hitting the foreign companies was actually a goal that made sense in relative terms.
You know, but just replying to that, I think that it is a provision that is too easily structured out of. I mean, I mentioned that we already have 163J to basically regulate the amount of interest expense that can be stripped out. But if you think about royalties as another one, it's very easy to reorganize your supply chain so that the foreign parent owning the IP contract manufactures with a U.S. manufacturer for a limited return, then sells the product to a U.S. distributor for a limited return, and makes all of its profit in a buy-sell. And since that is a cost of goods sold transaction to the distributor, you're outside the beat. So it's not clear to me what it really accomplishes at the end of the day that the other provisions haven't already.
Any of these problems are fixable by regulation, or?
I do not. I think that it was assumed that there would be embedded royalties and embedded capitalized interest in the cost of goods sold, and it would be beyond the legislation's intent to fix it by legislation. But it is, I think Tom is making another point that doesn't quite fit our binary point, because it is too harsh in many ways, but it's also easily avoided in other contexts. So it's, to me, that's kind of the worst of both worlds. So I'm not real happy with where it ended up.
Okay, so what do you guys think? The question is beat too harsh, too mild, just right? Is a good approach or completely misdirected, and where did the 3% or more come from? A, yes, too harsh. B, no, base erosion is a serious problem, and imposing a minimum tax on payments to related foreign persons is a good way to deal with it.
I love this.
Yes too hard, I gotta consider, see if I can read this.
19%.
Yes too harsh wins by 81%. 19% disagree with that.
That's less bad than I thought it would be.
Me too.
Okay, last question, question 4. Relates to the Act as a whole. The provisions of the Act addressing cross-border investments and transactions are complex, and in addition to those we've described here, include the repatriation tax in Section 965, changes to the foreign tax credit system, multiple sections, Subpart F, treatment of transfers of intangible property, the rules for transfers of intangible property generally, as opposed to just by U.S. shareholders, the source of income from sales of inventory, and the basic question, and the list could go on and on. I mean, just the number of acronyms is staggering, as we all learned this morning. The question is, and we'll start with Dana, is there too much change and complexity in the Act with respect to cross-border investments and transactions? Should we start over?
Well, I am not going to admit that I can't begin to understand it. I can begin to understand it. That's about where I am.
Right.
I think it's, what's Danielle's, the Tax Complexification Act of 2017. I do believe that is true of this legislation, but I still vote no. I think it's too late to start over, and we're going to have to work out the complexity over time.
But you think something has to be done?
I think something has to be done. I think this will, I thought that my mind was blown by the 84 and 86 acts taken together. I think over time, particularly with guidance that Doug promised today, that over time this will seem less complex than it does now.
Dan?
Well, although I'm not going to endorse yes, I'll start by saying when I first started reading about this darned act, just the international stuff, I couldn't keep it in my head for 5 minutes. I'd like read guilty, beat, and then like 5 minutes later, what are these things? I couldn't, I did the only thing I knew how to do, which was to write an article about them. So now I think I sort of understand them, but at a very general level. These guys, if they had my level of understanding, would say they don't understand it because they'd be getting client questions they wouldn't know the answer to. So I think I understand them conceptually a bit. I do think, obviously, there's a lot of, going to be a lot of complexity and a lot of planning things and a lot of open questions, a lot of rushed drafting and so forth. It's certainly too late to start over, and on balance, each of the three things kind of addresses something that's important in a way that's imperfect, but that it's hard to address really well. I guess I've been harshest about FDII, maybe not that favorable on the beat either. I think the good thing about it is there's been this misguided debate for a long time about, quote, worldwide versus territorial, which I think is simply a bad way of describing the actual choices that countries have. The banal point is that every country has a hybrid system, so if everything is a hybrid, then kind of the terms aren't really doing you much good. A more interesting point maybe is that worldwide and territorial don't really describe the choices countries are wrestling with and are trying to make as well as they can. Things like whether to hit profit shifting, to kind of have bad foreign source income versus good foreign source income that you treat less favorably. The kinds of choices that countries are actually facing are not illuminated by that. So we didn't go territorial in 2017. What we did is we got rid of deferral, which other people said the same thing by saying the exemption system. So what does the U.S. system used to say? It used to say, we'll tax a bit of your foreign source income now under Subpart F, and the rest of it in theory we'll tax later, but probably never. And if you weren't lying to your accountants when you said it was permanently invested abroad, then maybe we'll never tax it. What it now says is now or never. We're going to tax it now or we're going to tax it never, your foreign source income. Current year will hit you under Subpart F, or we'll hit you under GILTI or something else, or else we're not. I guess I'm really just addressing the outbound when I say this, whereas there's also inbound here. I think deferral was a bad system because it makes the taxpayers' incentives depend on what they think is going to be the future tax rate compared to the current tax rate. That kind of makes no sense. It leads to the trapped earning problems. So deferral was a bad rule. We got rid of it. We tried to replace it with other things that, as other people here have said, try to make it not tip the balance too much in favor of profit shifting. So in that general sense, along with things in each of these rules, it's kind of in the ballpark each time of trying to wrestle with tough problems in which even the answers aren't clear, much less how to implement them, even if you knew them. But it's too late to start over. We don't really want to bring deferral back. So this is kind of the world we're in now. We might as well grin and enjoy it, I guess.
Kim?
So a very wise tax lawyer once said to me many years ago when I started practice that, complexity is okay and maybe even desired by, big, large multinational corporations who can deal with it. But it isn't fair and it isn't right for small businesses and individuals. And I think that is true. And I think it is becoming even more apparent today. This bill, in its entirety, was written by a Congress who, well, I shouldn't say in its entirety, I should say in all of the international provisions, was clearly written by a Congress who thought that the only multinational enterprises around were big, sophisticated corporations, whether foreign parented or U.S. parented. The GILTI itself is a disaster as applied to individuals who can, of course, be shareholders of CFCs, who didn't get the benefit of the low rate on the repatriation or transition tax, who don't get GILTI foreign tax credits and don't get GILTI's lower rate. And by the way, all those problems are not solved by the 962 election, if any of them are solved. And that theme is not just about GILTI. It runs throughout all the international provisions of the Act. And it's gotten to the point where I really think that there will be massive non-compliance with this Act, not because people are cheating on their taxes or whatever. They just will not be able to comply with it. And if somebody like me tells them what they need to do, they're not going to believe me. Michael Caballero, I don't know if you're still here, it was said this morning, with all this complexity, it's not about intuition anymore, it's about modeling, and he's exactly right. Now, I'm an old lady. I've been doing this for 35 years based on intuition. It's about ready for me to retire, right? But I feel bad for the young people because there is no policy, there is no principle, there's no theme, there's nothing here except a bunch of modeling. And then you tell your client if it's a big, sophisticated, U.S. corporation, maybe you have some fun and you plan out of the 3% hurdle and all this kind of thing. But the whole world is not that. And Congress has completely forgotten that there are other taxpayers in the world, and I think it's just a real mistake. I have to put my sign.
Oh, yep, you do.
It's my last one, I promise. I would have written a shorter act, but I didn't have time.
That's good.
I have to say that Kim surprised me with the advice from her wise old mentor. I thought he was going to say complexity is good for profits in our business.
If you're with an accounting firm, Tom.
If you're KPMG.
But it is too late to start over. And, in my view, it wouldn't be advisable to go back to what we had. The old international tax system had become outdated. And this act really does accomplish two important things. First, it brings the U.S. headline rate more in line with our trading partners. And second, it eliminates the lockout effect. So going to what is effectively a worldwide tax system with bad and better kinds of foreign earnings, taxed as either old school subpart F at 21% or guilty. We have immediate taxation, but we've taken down that wall that kept cash out of the United States for reinvestment. And those are very good things. The changes that need to be made around the margins, we should start now. But I think the broad outline of the two major points are things that, as Tom Barthold said a few minutes ago, were broadly bipartisan concepts. So I think although our country now acts in a very partisan manner and things get passed by just one party, I don't think that there's broad disagreement that that was a preferred route. And certainly the 1962 Act, there was a lot of talk during the legislative process that this was the first big tax bill since '86. Well, '86 to me was more about horizontal fairness among individuals. I think the better antecedent is 1962. So we had a system that we lived with for 55 years.
We redid Surrey's 62 system, really.
Right. And not until Doug Palms joined Treasury were all the questions answered under the 62 Act. So, we went
I hope he's a little quicker
50
on
plus
that.
years before Doug got there. And, so complexity is unavoidable, I think. And, these will be worked out over the years and decades to come.
Okay, so last audience question. Yes, absolutely. Too much change and complexity. I can't begin to understand it. You can drop that if you want to. But to vote against the act, no. On balance, the changes are good, and in any event, too late to start over. I know what you guys are going to say, but you're consistent with prior votes, you're going to vote the act down, but
Yeah, they've been pretty sympathetic.
Holy
Wow.
cow.
60,
That's hard to believe, 50-50.
50.
What?
50.
Recount.
One off.
Wow. There we go.
It's 50-50.
Yeah, absolutely. Unpredictable.
We could separate out changes are good from too late to start over. See what.
Well, we could rephrase the question and do another poll if you wanted, but okay. Thank you, guys.
Thank you.
Early.
Great job.
Okay, well, thank you, Willard, Dan, Kim, Dana, and Tom for an impactful debate. The last voting 50-50, we don't know if Tom Barthold had weighed in, whether or not that would have swayed the vote one way or another. By the way, for those of you with a handheld device, please hold on to them. There'll be one more opportunity for audience polling during the industry session later this afternoon. Understanding the economic effects of U.S. international tax reform is of paramount importance in considering its likely impact on the commercial and tax behavior of U.S. and foreign multinationals. Our speaker for this topic is Alan Viard. Alan is a resident scholar at the American Enterprise Institute, where he studies federal tax and budget policy. Prior to joining the American Enterprise Institute, Alan was a senior economist at the Federal Reserve Bank of Dallas and assistant professor of economics at Ohio State University. He has also been a visiting scholar at the U.S. Department of the Treasury's Office of Tax Analysis and a staff economist at the Joint Committee on Taxation of the U.S. Congress. Alan, over to you.
Well, thank you all for being here. Thank you, Larry, for organizing this great conference and for inviting me to take part again. There's certainly a lot of interesting issues to discuss. I feel that I am able to discuss some of them and not others. The bewildering complexity of this new law is certainly something that many of us have noted. What I'm going to do today is two things. First, I'm going to discuss the corporate rate reduction. I think David Rosenblum is right to say that that is really the most important part of this law from an international perspective. It's also something economists have said a great deal about, and where I think a lot of the economic principles are clear, even though the magnitudes are not necessarily known. And therefore, it's something on which I and economists in general can really usefully weigh in. I guess I also believe that both supporters and opponents of the corporate rate reduction have been saying a lot of things that don't make sense. And I'm going to try to say things that I think do make sense, but you'll have to be the judge of that, I suppose. The second thing I'm going to do is try to make some high-level comments about the international provisions. I had felt a little discouraged with myself for not really understanding those provisions in detail. I feel better about that today after hearing the difficulties that all of you who have so much more grounding in this are also having. So I'm not going to be commenting on the details of those provisions, but I will offer some high-level thoughts that hopefully will be of some value. But let me begin with what I do think is the easier part, which is the corporate tax rate reduction. Certainly a very dramatic, very important part of the law. Clearly a portion of the law that was central, I think, to Republicans' objectives in moving forward with tax changes. What I do in this slide is really outline the basic, very simple economic story for the advantages that an economy might get from reducing its corporate income tax rate. And I think it's important to note these things simply because in many cases they're not understood well, that supporters of the rate reduction are trying to make other different types of claims for it that don't really hold up, and opponents are really attacking it on grounds that are unrelated to the actual economic case for it, which is not surprising. I think that in many cases the kind of off-point statements made by criticisms made by opponents are really responding to off-point arguments made by its supporters. But here in a nutshell is what incentive effects you would expect a corporate tax rate reduction to have. And here again, just abstracting from all the other features of the law and just looking at a corporate tax rate reduction. So first of all, even though the law used to have the name jobs in its title, and of course, as Tom and others have pointed out, it actually doesn't anymore, the corporate rate reduction does not have a direct effect on hiring incentives. I think that's a point that's often misunderstood. And the reason, of course, is that there are offsetting effects here that cancel each other out. It is true, of course, that if the corporate rate is reduced from 35 to 21%, then an employer that is deciding whether to hire a new worker and pay them wages knows that they will be able to keep 79% instead of 65% of the output or additional revenue produced by that worker's efforts. And so, of course, that obviously is an incentive to hire the worker. But since we know that with rare exceptions, wages are deductible in computing taxable income, there is obviously an offsetting effect, which is that the out-of-pocket costs of paying the wages are now only 79% instead of 65%. And so on the one hand, the company will keep more of what the worker produces, but on the other hand, they will bear more out-of-pocket cost of hiring them. And of course, it's an offset no matter what the rate is. If a worker can produce $100 of output, then they should be hired if the wage is $100. That's true at a 0% rate, it's true at a 21% rate, it's true at a 35% rate, because no matter what the rate is, it's reducing both sides of the equation by the same percentage. And of course, the same analysis, as we know, applies to any investment that can be expensed, at least unless firms are kind of misled by financial accounting rules, which is an interesting topic in its own right that we can't get into today. So these are not areas where we would expect to see direct incentive effects, either on hiring or on expensed investment. But we would expect to see them for depreciable investment because there the tax rate reduction increases the hurdle rate or reduces the hurdle rate that the firm requires in order to make the investment. It's simplest to see if tax depreciation happens to exactly match true economic depreciation, because in that case, the hurdle rate that you need before tax is just equal to whatever rate you're demanding after tax divided by 1 minus the tax rate. And so if the rate is 35%, you need a hurdle rate that will cover that 35% wedge. Once the tax rate goes down to 21%, the hurdle rate is lower because you only need to cover a 21% tax wedge, assuming that interest rates remain unchanged. And that's an absolutely crucial qualification that I'll come back to in a few slides. And so the story here is that we would expect the corporate tax rate reduction to give self-interested, profit-maximizing corporations an incentive to engage in additional depreciable investment that they otherwise would not have done, that they would not have done at all, or that they would have done abroad instead of in the United States. So that's one effect we expect to see as an increase in investment. What implications does that have for the labor market? Well, here there is an effect on hiring and wages, although you can call it an indirect one, which is, of course, that when the additional investment occurs, the capital stock becomes larger. A higher capital stock makes labor more productive. The worker who previously could produce $100 of output and whom you were willing to pay a $100 wage to you were willing to hire if the wage was $100 or less. Now that worker maybe can produce $105 worth of output. Probably not actually that big of an increase, but just as a round number. And so now, of course, anybody who is willing to hire the worker at the wages that used to prevail would be even more eager to hire more workers than before, again, as a matter of self-interest, because that worker will provide output to the firm that is worth more than the previous level of wages. And so every self-interested employer will then want to hire additional workers because of their additional productivity. The employers will compete against each other to hire the workers that are available, and as they do so, they bid up the wages that the workers are paid. So employers are forced to pay higher wages in order to hire workers away from other firms. And of course, if the higher wages induces people to enter the labor force who otherwise would not have, then it also does increase hiring. And so that's the basic economic case, which I think often gets lost. And if you listen to supporters and opponents of the rate reduction, they're saying all kinds of other things that just don't line up with this. And so I want to make a few comments about this, just the basic logic here. And the first is that there really is, among economists, very broad agreement on this story and the basic outline of it and the principles involved, even though there is a great deal of disagreement and a great deal of uncertainty about the magnitude and the timing of the effects. And just a couple quotes here I think that really cover it well, both from the New York Times in recent months. Justin Wolfers, who is ambivalent about the tax law, explains a tax cut increases the incentive to invest. Very few economists debate its underlying logic, although there's considerable debate about whether it's a large or small increase in investment that we're talking about. Nobel economics laureate Paul Krugman, who is adamantly opposed to the tax law, also outlines the theory in great detail and pretty much in line with my earlier slide, and concludes, to be fair, there's probably something to this theory. Something, but not very much. And so I think that illustrates kind of the views that are out there. Obviously, if we put someone on the slide who is a diehard supporter of the tax law, they would probably give a very effusive statement of how big these effects are. But the basic story, I think, is pretty clear-cut. To address, I think, what may be the most troubling misconception about this is that the story depends entirely on incentives and self-interest. There is no role in it as it stands for cash flow, and certainly none for altruism on the part of corporations. The theory assumes that firms are completely self-interested, so it does not assume that upon receiving a tax cut, that firms will give some of that money to workers. There's no conceivable reason to think that employers would do that to any systematic extent. But of course, you would think that employers would pay more if they were bidding against other firms to hire workers who would become more productive because investment had expanded the capital stock. I saw an article recently in the mass media which said that companies' sharing of their tax cuts with workers had been less generous than had been hoped. Well, it certainly was not less generous than the economic theory suggested, because the economic theory suggests there would be no generosity whatsoever. And so presumably there would not be less generosity than that. So that, I think, is a pretty serious misunderstanding. And I will in a few minutes, be discussing these one-time bonuses, where I think we've seen a lot of these misconceptions by supporters and opponents of the new law. Another thing that really, it's almost like, someone like scratching their finger on the chalkboard, because it just, I'm like, oh, is when I hear people talking about how the tax savings are being used. Because again, that of course is not anything about what the economic theory is discussing. The question is not how you use your savings, tax savings from the investments or other decisions that you've already made. The question is how a self-interested corporation would change its behavior in order to obtain larger tax savings. And so in this instance, of course, the fact that there is a rate reduction on your U.S. taxable income means that you would increase your U.S. taxable income to obtain larger tax savings, and you would do that in large part by investing more in the United States. And so this question of how the tax savings are being used is completely misdirected. And so in the standard economic model that I'm presenting here, investment behavior is determined by the profitability of future investments. It's not the tax savings on the past investments or the unrelated cash flows that the company may happen to have. So in other words, if the corporation, for some reason, were to buy a lottery ticket and happened to get the winning number, and so the company had a payoff from the lottery, we would not expect them to undertake investments that would otherwise not be profitable. The fact that the lottery ticket paid off has no implications whatsoever for the profitability of any of the investments that the company could be considering. And so the only exception to that would be if the company was liquidity constrained and due to a lack of cash couldn't make some investments that were profitable. And so I guess in that case, of course, the lottery payoff might induce some increase in investment. But for the major companies that are getting the bulk of the tax savings here, we don't really think the liquidity constraints are an issue. And so that is not at all what we're looking for from this tax cut. And so that, I think, is the basic economic story we want to look at. And then the relevant question becomes, what size of effects we should expect. Well, if we want to answer that question, though, we've got to go back to the interest rates, because I mentioned earlier that the key assumption of interest rates staying the same. And under that assumption, the story really holds up very well. In fact, it's very interesting if you actually work through kind of a standard economic model under the assumption that interest rates are just fixed at some value and won't change in response to tax policy or in response to investment demand or such not, you really do get like a very simple policy directive. And I think in some ways we might all wish that we did live in this fixed interest rate world because we could kind of go home. What we would say then is that a corporate rate reduction actually is very beneficial. Workers receive higher wages by a very substantial amount. Now, it's true that, except in extreme cases, the corporate rate reduction still does not pay for itself. And that notion certainly has no foundation that we're somehow going to have a revenue gain or no revenue loss. There would be a revenue loss. And you may say, well, then there is really a trade-off here, higher wages, revenue loss. But in this fixed interest rate world, things would still be great because the wage gain for workers would be larger than the revenue loss. And so you could make up the revenue loss completely by taxing workers, and yet workers would still come out ahead. And so again, what you'd want to do in that fixed interest rate world would be pretty straightforward, and it's really an economic theorem that you'd want like a zero corporate tax rate. Well, we don't actually live in that kind of world. I think it's quite clear that higher investment demand will in fact drive up interest rates. If that's the only thing that's going on, just that as companies go out there and try to invest more, the way the simple story says they had to pay higher interest rates, if that was it, if that was the only thing that was causing interest rates to go up, you would still get higher wages and higher investment as a result of this corporate rate reduction. Now, those wage gains would not necessarily be bigger than the revenue loss. They might quite easily be smaller. And so then there would be, what's the net impact on workers? Well, it's going to depend on how you pay for that revenue loss. And so the picture obviously becomes more murky as to whether this is a good policy or a bad one and requires some difficult value judgments. There is another factor to bring in, though, which is that if the corporate rate reduction is deficit financed, which of course happens to be the case with Public Law 11597, then you have a further interest rate increase through that channel. And under those circumstances, it's not necessarily clear that investment in wages will even increase on net. In my view, it's likely they will, but that may depend in part on the time horizon you're looking at. Increases in the very long run may not be as likely as they would be in the medium run. It also depends on how long you allow that extra debt to stay out there before you begin servicing it, and it depends on how you do service it once you get around to doing so. So what we'd really like to know, I guess, is what the size of these effects are, and so it would be great if I could stand up here and give a number. Certainly not going to be tempted by that type of hubris. There's just too many factors that would come into play here. The statistical evidence, for example, on how corporate tax rates are related to wages is really all over the map, and I've really, personally at least, given up on trying to get too much useful guidance from those statistical studies. So I really think this is an area where, because it is so difficult to do statistical work that adequately controls for other confounding effects, we really should go back to theory and look more at economic models. Unfortunately, the models give a pretty wide range of results as well, depending on numerous factors. You can see some models where output and wages basically don't change. You see others, for example, that assume fixed interest rates, and those would tell you that in the long run, the level of output would be maybe 3% higher, 2 to 3%. Of course, as I've said, the fixed interest rate assumption is unrealistic, and so in my view, the 2 to 3% estimate would be too high. I do want to make one crucial point that really gets lost quite easily in the debate. Another one of these things that is like the fingernail on the chalkboard type experience is when I hear people talking about what change there will be in the growth rate of the economy. And people say, well, we're expected to grow at like 1.8% a year in the next 10 years before this law was passed, and what will this growth rate become? What will it change to? Well, of course we expect it to change growth rates, but that's really the wrong way to look at it. We don't expect there to be a permanent change in the growth rates. Neither this tax change, nor any other tax change, nor most policy changes will permanently change the growth rate to say, oh, we're going to grow at 2% a year or 3% a year forever, when we otherwise would have grown at 1.8% a year forever. Instead, if the policy is permanent, we would expect it to permanently change the level of the output. And so, of course, the growth rate would rise temporarily to get us to that new level, and we would then revert to the growth rate we otherwise would have had at that higher level. So suppose you take the optimistic case of a 3% increase. Maybe I should refer to that as unrealistic instead of optimistic, since it does require the fixed interest rates. I think it would clearly not, it almost certainly not be 3%, it'd be lower than that. But if it was 3%, and suppose that full 3% increase was in place at the end of 10 years, and suppose it occurred smoothly over those 10 years, what that would translate into is an increase of 0.3% per year in the growth rate over those 10 years. And so if you were otherwise going to be growing at 1.8, you would grow at 2.1 for those 10 years, and then you would go back to 1.8. And so that, again, probably the actual effects are smaller than that, but that gives you a sense of what kind of effects you might be looking at. I think it does provide some perspective on the claims of people who say, oh, there'll be a permanent change to a 3% growth rate or a 4% growth rate. Or let alone a 6% growth rate, which was mentioned by the president in one of his speeches. Just a word about these employee bonuses. I was, of course, kind of surprised these bonuses occurred. I guess what did not surprise me, although it disappointed me, was, of course, that supporters of the rate reduction seized on the bonuses as a success story of the law. And saying, well, gee, we said it would raise wages and, give workers more money, and it's doing that. So, good news on that, case, proven. Well, that can't be right, of course. Remember, what causes the wage increases to occur is that there's additional capital in the economy that makes workers more productive. So if the wage increases would occur as the additional capital comes online. The one-time bonuses cannot be that. Timing is exactly wrong because it gives workers more money at the end of 2017 or the beginning of 2018, which is far too soon for the capital stock to have expanded. And of course, the one-time bonuses in and of themselves don't give workers anything in the upcoming years when there would be an expansion of the capital stock in place. So clearly these are not responses of the economic type to the tax law. I guess one possibility is that they are public relation responses to the tax law. That seems actually unlikely because this would be kind of expensive to give these bonuses for PR reasons that you otherwise wouldn't have given. Probably the more likely story is these are bonuses that would have been given anyway because of tightening labor markets as the economic expansion continues. And then for public relation reasons, the companies attribute them to the tax law. So they may be trying to win goodwill with the public at large, or since some of them are in regulated industries, they may be trying to win goodwill with the president. And there's been some articles on that. Well, the path's not taken here. I just mentioned a couple. One is that, I said that the favorable investment effects, which then drive the wage gains, occur because of the increased profitability of future investments, and it is not a matter of using the tax savings from your past investments. This really suggests, of course, that it would be desirable to target the tax relief to the future investments and away from the past investments. Now, one way to do that is by expensing instead of rate reduction, and of course there is some expensing in the law along with the rate reduction. Financial accounting rules may induce some firms not to fully respond to that. Another way to do it, though, if you are determined to lower the corporate tax rate, is that, as my colleague at AEI, Alex Brill, and I recommended last year, you could phase in the corporate rate reduction over a number of years. That would limit the revenue loss. It would limit the windfall gain that shareholders would receive on investments they've already made, while keeping in place the favorable incentive effects for the future investments that firms might make. Well, obviously that path was not taken. And then, since the deficit financing is really an economic problem here, you also might have wanted to try to offset the revenue loss. And one way to do that while maintaining progressivity, or perhaps even increasing it, would be to increase taxes on shareholders. As you know, Eric Toder and I have a plan on that, which he and I discussed here, I guess, 2 years ago. The late Harry Grubert and Roseanne Altshuler also have a very similar plan. That path also not taken. All right, well, I'm going to try to say a little bit about the international tax provisions, and certainly do that with some trepidation. So simplified description, and the simplified almost doesn't do justice to it, I guess. As Dan Shaviro was emphasizing, and many people have pointed out, these worldwide and territorial systems are really, almost caricatures in a sense, and most countries, or all countries, actually have hybrid systems between the two extremes, and certainly we did so before this new law, and we now still have a hybrid system. It's obviously a different hybrid system where instead of taxing earnings as they're repatriated, we tax them currently under GILTI, or we don't tax them at all. Another feature is, of course, the one-time mandatory tax on past unrepatriated earnings within the provision for tax-free repatriation going forward. And then we have FDII, and we have BEAT, an export subsidy and an import tax. And so these things affect many different margins of choice. Another point that Dan Shaviro repeatedly emphasizes, that you want to look at all the different incentives that are being affected, not just one of them. And I'm going to look at a few of them, but certainly by no means all in the time that I have. One key question, of course, is where income is located, which includes both where physical, real investment occurs, and also where income is booked under accounting strategies. Both the worldwide and territorial systems penalize U.S. investment and U.S. income reporting by foreign parents, because, of course, the U.S. will tax income that is booked here by foreign companies, but not but not income abroad. The worldwide system has additional distortions built into it, which is that it will penalize investment that is done through U.S. parents relative to investment that's done by foreign parents. That's a distortion that's gotten a lot of attention and is often called a competitiveness concern. It also, as again Dan Shaviro emphasizes, it penalizes the avoidance of foreign income taxes by U.S. firms by giving a credit for the taxes that they do in fact pay, the credit for taxes that they don't avoid. So those are additional distortions that are built into the so-called worldwide system. Of course, the territorial system comes with its own set of distortions, which is that it penalizes U.S. investment and U.S. income reporting by U.S. Parent companies. It says, yeah, we're not going to tax you if you can book your profits abroad through real investment or through accounting. So how do we think about the new provisions here in terms of this worldwide territorial dichotomy? Well, again, as many speakers have emphasized, and I think it's absolutely right and absolutely crucial, this is not a territorial system. It is, a hybrid system. In some ways, it almost looks like a worldwide system, but with a low rate under the GILTI provision. To the extent that we do bring in the dividends received deduction, and by itself that would be territorial, well, that is removing the problems that the worldwide system distinctively poses while amplifying the problems that the territorial system imposes. But GILTI, by moving us back from territoriality, really just has the opposite effects. It mitigates the problems of territoriality. It gives U.S. companies more of an incentive to book profits here as opposed to abroad, but then it's reintroducing the worldwide problems, notably putting the U.S. parent U.S. parents at a disadvantage relative to foreign parents. So we have that seesaw between the problems that worldwide poses and the problems that territorial poses, and we're continue, I guess, to find an in-between solution. We will see, and this was mentioned in the debate panel, some of the reasons why the new, why there are some advantages and some disadvantages to the new way that we are going about this. So just in terms of the income location things, FDII and BEAT are trying to target income shifting and mobile above normal return investments. I think it's clear that they're highly imperfect in how they do that. I just want to say, of course there was an approach considered that really would have been much more elegant and much simpler and much more comprehensive in this approach, which was, of course, the border adjustment, and Roseanne Altschuler and I discussed that last year. This would have applied across the board to both inbound and outbound transactions. It would have automatically removed any U.S. tax incentive to shift income abroad or to move above normal return investments abroad. There would have been no special rules required to identify those things. Those are the things that would have experienced a net effect from a uniform border adjustment that applies on both the import and the export sides. So it would have been automatically self-selecting. The border adjustment did have some drawbacks, such as transferring wealth to foreigners who had investments in the United States at the time the border adjustment was introduced. But it would have actually solved all these things very well. Of course, and so what we've done is we've really abandoned that approach and moved to these really complicated provisions, which I view as the border adjustment's illegitimate children. And they're trying to do this kind of thing, but they do it, much less well. Of course, one of the big criticisms of the border adjustment was that it would almost certainly, be struck down at the WTO. And so you might say, well, okay, so we couldn't do that, and so we need to do something instead that would be WTO compatible, even if it doesn't work as well. The problem, of course, is that it seems highly doubtful that these measures are WTO compatible, and so it's not quite clear, why we move to that. The GILTI and the FDII, I think, in isolation, of course, do encourage, shifting intangible investments abroad, although, less so probably than a pure territorial system would. I want to echo Dan Shaviro's point again. The 10% is too high of a rate if it's intended as a proxy for normal returns, which I believe is what it is intended to be. The normal return can be proxied for actually by any investment that is available on the margin to firms. If firms had available to them a 10% safe nominal return, then a 10% fixed nominal imputed rate of return would be a valid proxy for the normal return. But of course, safe nominal interest rates are less than that. Granted, here you also should make an allowance, I guess, for bankruptcy risk that the firm faces. But that would still tell you, like, use the firm's bond rate, not 10% nominal. Of course, the market return would be a perfectly valid proxy. It would be, I think, it would drive people crazy, and it would be hard to administer because, you know, one year the market return is 30%, and the next year it's negative 20%, and so you would have a proxy return given to you towards the end of the year that was bouncing around from 30% one year to negative 20% another year. I don't think the market return in practice would be a very administrable proxy for the normal return. So some people are tempted to say, well, let's use a fixed rate equal to the expected return on the market. No, that's not a valid proxy because you're putting in a safe imputed return that's not equal to a safe market rate, but instead is equal to the expected return on a risky portfolio. But any of these rates that are available in the market is a valid proxy because they're all ex ante equivalent in the market, even though they are different ex post. So the 10% is too high. You know, as Dan Shaviro said, I guess I find myself really agreeing with almost all of his points. You know, the one kind of desirable effect here that we see is just a more rational treatment of repatriation. And the point in particular is to not tax the repatriation. It never made any sense that tax would be triggered by that particular financial transaction. It clearly introduced distortions. There's no reason why foreign subsidiaries should be holding more than $2 trillion of unrepatriated profits at the subsidiary level instead of sending them to the parent through a dividend payment or otherwise. And so that distortion has been removed. At the same time, though, I think we need to, you know, beware of the notion that this money is coming back to the United States and will be invested here. And we saw the clip this morning by the president, about the money coming back. You know, I mean, what we're talking about here, of course, is the money being transferred once repatriation is tax-free, and we expect this vast amount of repatriation to occur. We mean, of course, that a large amount of funds will be moved from the bank accounts of foreign subsidiaries into the bank accounts of U.S. parent companies. And the notion that that will then cause the parent companies to engage, you know, to use that money for additional real investment in the United States is, of course, the same mistake as talking about the use of tax savings or about thinking that a company would use its winning lottery ticket to make additional investments in the United States. You know, the fact that this money has moved from one bank account to another doesn't change the profitability of any future investments that could be made in the United States. You could tell various stories about why there might be some minor investment effect, certainly not a major one. Instead, you would expect that all else equal, the increase in repatriated funds should be distributed to shareholders or used to retire debt, which of course is what appears to have happened with the elective holiday in 2004. So, you know, while supporters of the tax cut are talking about the bonuses as a success story for the tax cut, the opponents are talking about the stock buybacks as a failure, but that doesn't make any sense either. That's what you'd expect the repatriated money to be used for, all else equal. Now, true, of course, all else is not equal because we hope and expect that the corporate rate reduction will induce self-interested companies to invest more in the United States. And so, you know, presumably the amount of buybacks should not go up quite by the amount of repatriation because this other thing is coming along to make investment more profitable. But the fact that there is a vast amount of buybacks following a vast repatriation of funds is exactly what you would expect, because we just don't think that the repatriation in itself is going to boost investment, which is something I've discussed before back in August. Another point, I guess, that Dan Shaviro often talks about, the avoidance of foreign income taxes, which, you know, can promote U.S. national interest if it's not, you know, money that should be in the U.S. And so the TCJA, the new law, whatever you want to call it, does lower the penalty on avoiding foreign income tax, because obviously we don't have a foreign tax credit on the income that's tax-free under the DRD, and the GILTI credit is set up at the 80% rate. There are a couple problems with it, which I don't want to take time to repeat here, the year-by-year approach, and then the pooling across, the cross-crediting across countries. So that's probably not something that features you would really want. So just a few references here, and there's many you could turn to. I have an article in Tax Notes on back in March 5th that discusses all these issues and some further things. There's a paper forthcoming in the Brookings Papers on Economic Activity, which I really want to recommend to anyone who's interested in trying to get a sense of how this law may affect the economy. It has two authors, one of whom is Robert Barrow of Harvard University, who is also a visiting scholar at AEI, and so my colleague. He is a strong supporter of the tax law. The other author is Jason Furman, who is a strong opponent of the tax law and who was chairman of the Council of Economic Advisors in the Obama administration. These are both top-notch economists. I'm privileged to know both of them. I think it's just fantastic that Brookings persuaded the two of them to co-author an article on a topic where they disagree so strongly. And I think that the product they came up with is a very good one. It really sets forth the various possible effects that could occur and the evidence that might point one way or another, and what things might be expected to occur, what things might not be expected to occur, like the tax cut paying for itself, for example. And that's forthcoming in the Brookings Papers on Economic Activity. And so I think that will definitely be a classic in the literature on this tax law. So just strongly urge that. And then Marty Sullivan had a good article back in Tax Notes in January. And as usual, very thorough analytical article where he really does what I did not do here, which is to dive into the weeds on GILTI and FDII and BEAT and try to quantify all those, how those different incentive effects would reinforce or offset each other. Well, there's many, many more things that could be said, either about the international provisions or other provisions like the net operating loss rules, the expanded expensing for equipment, the scheduled move away from expensing for research, and so forth. But I guess with 13 minutes left, I should open this up for questions and see what is on your minds. Oh, over. We have one question over here.
So I guess beating up on the beat does make the bat look good.
Everything is relative, isn't it?
And when we were thinking about the bat, I think one of the concerns was that a wholesale implementation of the bat would be, require this reliance on a foreign currency adjustment that was massive and had windfall issues.
Yeah.
And since you mentioned phase-in as maybe a better way to do things, it made me wonder. And I think I asked at the time, being very politically naive, why not just a little bit of BAT and a corporate income tax? And I think I was told politically Republicans can't enact a second tax. But of course they did that with the BEAT, the new alternative minimum, nasty, brutal BEAT tax. So it seems that they can. Can you do just could we replace, now we're starting to think, how would we fix the BEAT? What would we do? BAT's looking kind of good. Can we do like a little BAT?
Yeah, I mean, I think from an economic perspective, you can. So for example, suppose you have a 20% or 21% business income tax, either the 20% rate from last year, the 21% we finally ended up with in the new law. You don't have to have a border adjustment that's at a 20% or 21% rate. For it to be trade neutral, you do want it to be uniform. The economic theory about how nicely and elegantly a border adjustment works applies to an immediate, permanent, uniform border adjustment, an IPUBA, an IPUBA. So immediate and permanent so that there's no variation over time, but then uniform, meaning that the same tax rate applies to all imports and the same subsidy rate applies to all exports, and those two rates are equal to each other. And so if those conditions are met, you really can have the rate be anything you want. So you could do a 1% border adjustment or a 5% border adjustment or a 10% border adjustment. Doing it at the same rate as the business income tax rate, has the best effects in terms of neutralizing any domestic tax incentives for profit shifting. If you have a rate lower than that, you are mitigating that income shifting problem instead of solving it. But there is no reason why you couldn't do that. It would make those windfall effects smaller. I do think, to my mind, the biggest economic disadvantage of the border adjustment always was the fact that it gave a rather large tax cut to foreigners who were holding U.S. investments on the date that the dollar-denominated investments on the date that the border adjustment is announced. There's other windfall changes, too, that people had legitimate concerns about, such as countries that had borrowed with dollar-denominated debt, developing countries. And all those effects would be mitigated if you had a smaller border adjustment. So there is no reason you had to preclude that. The fatal problems, though, with the border adjustment seem to be that people either did not understand or did not believe the economic theory. And so I, don't know what to do about that. And I think that would be a problem, of course, at the lower border adjustment than as well as at the bigger one, maybe less of one. And then, of course, the other concern was the WTO issue. And I don't know whether, like some of the WTO, again, one of the WTO objections is that the tax applied to an imported item is larger than the tax on a similarly situated domestically produced item because you have a wage deduction if it's produced domestically. And if you make the border adjustment small enough, that problem sort of goes away, at least on average. Now, is that good enough for trade lawyers? Well, I do not know. That is their prerogative. And none of those objections, again, really made economic sense. But yeah, I don't know. Seems like a worthwhile option to me. I wouldn't, give it any much political traction, unfortunately. It's a good question. If the beat goes away one way or another, what will replace it? One assumes that it couldn't be much worse than the beat, but those could be famous last words.
As the deficit grows as a result of these policies, and none of the positive effects of what they were supposed to do, like you were talking about the repatriated cash, what do you expect to happen with the economy overall, and do you think it will engender another tax reform?
Well, so I guess you may be asking a number of things there. I think that my own view is that on balance, the corporate rate reduction will likely still boost output and wages to some extent, even though it does add to the deficit. As I mentioned, that is by no means clear as a matter of theory. And of course, the favorable effect would have been significantly larger if it had not added to the deficit. In terms of how we will deal with the fiscal imbalance, that is a long-standing question. Every time we take an action that makes the fiscal imbalance worse, it becomes more pressing. It also becomes more pressing even when we don't, just because we are moving forward in time and the future increases in healthcare and retirement spending loom ever closer. So I think there's two possibilities. One is that a crisis occurs and we then deal with this in a crisis situation. Now, I don't think a crisis is imminent by any means. And again, this is a case of people making, I think, bad arguments for good reasons. I think we want Congress to address the deficit as soon as possible, which is, of course, right. So let's say that a crisis is right around the corner. And that may prompt Congress to take action. Well, first of all, it hasn't prompted Congress to take action. And it obviously creates the crying wolf syndrome because the crisis doesn't occur. And I suspect we could run the debt up considerably more before a crisis hit. And we shouldn't do that. We should act now before there's a crisis. But it's possible we'll wait until there is one. The other alternative, which does look maybe hopelessly optimistic, is that at some point there actually will be a fiscal package adopted to narrow the long-run fiscal imbalance. If that happens, I think we can say several things about it. First, that it will include both tax increases and entitlement spending reductions or restraints of entitlement spending growth, because it's just hard to imagine a politically feasible package that included only one of those two measures. If a measure that includes those kind of unpopular steps is adopted in a non-crisis situation, it will definitely be by bipartisan agreement. It is inconceivable that either party would do that alone. and then be hammered for it by the other party. And it also follows, I think, that it would occur at a time when the two parties are sharing power, when, when we do not have a single party controlling both chambers of Congress and the White House, because it's just hard to imagine the party that is out of power signing on to that with the party that is in power. I guess the other thing I would say specifically about that package is that it will almost certainly include a value-added tax, which is really hard to see how you would avoid doing that in a package that tries to address the imbalance in a serious way. And ironically, of course, this means that we would end up getting a border adjustment because, of course, the VAT would be border adjusted. And people actually seem to understand the economic theory of how a border adjustment works when it's done as part of a VAT, but they don't understand it when it's done as part of a business cash flow tax. So that will be, I guess, maybe the way in which the border adjustment eventually rises again. Probably not in any other form, but when we, I believe, finally move to a value-added tax. Have all the questions been answered? No uncertainties remain. No uncertainties that you think I can address. You're probably right about that one. Oh,
Thinking back to 1981, when President Reagan took office, we had the Economic Recovery Tax Act, which
Yes.
cut the rates and for both individuals and corporations.
It lowered corporate taxes
Yeah.
through depreciation and investment tax credit, yeah.
There was a recession, interest rates were very high. It didn't really jumpstart the economy the way they thought, and it expanded the deficit just like you have today. And then after that, we had TEFRA in '82, we had the '84 Act, and then in '86, we had what I consider to be like true reform as compared to this act. Do you think it's possible after this act that in another year or two, if things aren't working out, there'll be like a mini, some kind of modification in 18 or 19 or 20, or maybe it goes to the next administration?
Yeah, well, so this is obviously an excellent question, and it's a question, I guess, about sort of near-term political events, and I think those are very hard to predict. It's certainly very hard for me to predict. My training is in economics. I was, of course, just venturing opinions about the politics of, what could happen with long-term deficit reduction. I feel a little more comfortable on that than trying to predict short-term political trends. The '81 precedent is very interesting because you had this whole series of tax increases following '81. And then Ronald Reagan was still able to run for re-election in '84 on the pledge that he wouldn't do any tax increases. So that was truly amazing and quite impressive, I guess. But I don't know that is a good precedent for today. I think that, frankly, the congressional Republicans are just really, really averse to taxes. And so to see them agreeing to the kind of tax increases that we saw in '82 or '84, I just don't really think that it's in the cards. Now, in terms of will there be some modifications of this law, I'm sure that will happen. I mean, some of them will be under the rubric, of course, of technical corrections, and Tom told us about the timetable in which that, could occur if Congress decides to pursue it, and I think all of us hope that a good technical corrections bill is passed because it's obviously sorely needed for this particular law. I think there will also be policy changes. You've got to think that things like the BEAT are going to be changed in some respect, for example, even if the WTO doesn't kind of force our hand. But, I don't know that those changes are likely to be revenue raising. Indeed, I almost wonder if they might not be revenue losing, which would certainly, in my view, not be the direction to go. I do think that, addressing the fiscal imbalance is just not something I see happening in the near term. I wish I did. I'm predicting it won't happen in the near term, but I certainly hope I'm wrong. All right, well, it looks like my time is up, so thank you all very much.
Alan, thank you very much for your thought-provoking presentation on the economic effects of U.S. international tax reform. It's now time for the afternoon break. Coffee and refreshments are available across the hall. Please make sure to return by 4:40 for the panel that will cover the industry perspective of U.S. international tax reform. Thank you.